Greg, it's great to see you, and thanks for taking the time to join us for the 2023 Pinnacle Insights Live series.
Thanks, Jared, and sorry that I had to make it an almost live series.
Now, some of our clients did indeed get to see you in person here in Australia in 2022, but I think it would be good to do a quick background recap. You launched Langdon Equity Partners, a specialist global smaller companies investment boutique last year. Tell us briefly a bit about your background and how things have been going over the past 12 months.
Yeah, it's about 6 months ago that I was on ground, and time is flying. So the last year has been busy. We've built out the team, established the firm, and set up 3 investment vehicles. Obviously, the global smaller companies fund down in Australia, and also 2 Canadian mutual fund portfolios available to Canadian clients. And we've just seen really strong momentum and responses in both markets. And we think a lot of that has to do with our track record and reputation and the success we've had, investing on behalf of clients for the last 10, 15 years. But also, it's a really interesting time for the asset class, and we think it's underowned and underappreciated. And the way in which we approach it, being focusing on long-term compounders and owning them as small as we possibly can, has been very differentiating. When you think about the last year, it's been really tough for larger companies. They had a fantastic decade, and in many ways took a lot of the credit that often small caps deserve. And so for us, we're looking at businesses where we're just trying to own the underlying rate at which they compound. So if you look at this slide, you can see we don't try to buy things and then sell them at higher prices to somebody else. We're just trying to benefit from the underlying rate in which a company is compounding, and we think, in the event you own a business forever, that's the rate that you're going to earn as a shareholder or as an investor. So I think sometimes people forget that, and certainly in the last couple of years, it's probably been a little humbling to remember that a lot of businesses grew a lot faster than their underlying rate of compounding, and so we're kind of seeing that mean revert here in the last little while.
Okay, let's get into the investment side of things and talk global small caps. Amid the market sell-off in 2022, small caps were hit particularly hard. Can you take us through some of your views on the asset class more broadly and how you see it positioned as we do move into 2023?
Yeah, I feel like almost disappointingly, our views don't really change. The 2 best parts of this asset class and why we've decided to dedicate our careers and build a firm around it is that, number one, small cap universe is enormous. It's roughly 70% of the companies that exist in the world, but it's only 14% of the market cap. So, if you flip that around, if you're looking at large caps only, you're only looking at about a third of the companies that exist, and that represents close to 90% of the available market cap. So we have this enormous pond, and the second best thing about it is that it's very under-resourced and under-followed. So on average, 5 to 6 people will, from the sell side, be looking at a business that exists in small cap versus, close to 24 people who will follow or cover or report on larger companies. So we just feel like we have a pretty big advantage relative to people that operate in other asset classes just by looking where others aren't.
Yeah, as you say, there does remain a lot of noise in the macro, a lot of debate about the macro. So what is it that the Langdon team is focusing on right now as bottom-up stock pickers?
Yeah, so if you ever find us in conversation on interest rates, government policy, commodity prices, or things of that nature, you definitely want to leave that conversation. We've set the firm up, and our whole investment approach is oriented around not having to make calls on those things because A, we don't think we're very good at it, and B, we haven't met anybody else who we think is very good at it. We think those are just really hard things to forecast, and most times the batting average is closer to flipping a coin. So we are looking at companies that largely control their own destiny, are of what we deem to be very high quality. So that means high returns on capital, where cash is king, so cash flow versus adjusted EBITDA, adjusted earnings, normalized this or that. We tend to take a very skeptical view to the accounting, and we want to make sure that when they say profit, it actually can be found in the cash flow statement and not in the adjustments. And that's true of any business, any sector that we're looking at. So it sets us up well to be looking at smaller companies who are able to grow through high returns on capital and strong cash conversion, which I'm sure we'll talk about later.
Well, if we do take that a step further, how would you summarize the characteristics of some of the typical stocks in your portfolios?
Yeah, so we're looking for three things. We're looking for high cash conversion, so economic profit and cash profits roughly approximating one another. We're looking for very low levels of balance sheet debt because as we say, it's like a performance enhancing drug. It makes your good better, but it makes your bad worse. So we're trying to find businesses that don't need to use those sorts of substances to create value. So low leverage, high cash conversion, and also high rates of reinvestment. So businesses that are investing heavily to grow their business, sustain their business, and potentially make acquisitions. Those are sort of the three cornerstones to what we deem to be a great compounder.
All right, let's dig into that portfolio a little bit more now. Can you share with us one or two of your holdings that do exemplify some of those characteristics and, of course, in which you think have great prospects for 2023 and beyond?
Yeah, so one common theme is, we take a long time to get to know a company and rarely will make decisions quickly. We tend to do a lot of work over longer periods of time because it's just really hard to build trust or accelerate the ability to build trust. So both of the companies I wanted to talk about today are companies we followed for one close to 10 years and the other one more than 10 years. And they're still small, which is neat. So one is Thule, which is probably a super well-known brand. Anyone who's an outdoor enthusiast or has kids or pets would have interacted with the Thule group. They're based in Sweden. It's actually a design and contract manufacturing business. So they don't actually make much of what they sell. They actually just really do final assembly and marketing and R&D. And it's a business that went public in 2014. It was a bit of a mess, and it was a bit of a failed private equity roll-up privately that then had to go public to delever. We met with them on the roadshow. We decided at that time not to make an investment, but it's a business that we now own today because we think that the market is misunderstanding some of the short-term dynamics that are related to COVID, but also the fact that Thule's investing close to 6% of their sales in R&D in new product development. So one of the things that you'll see this spring is actually Thule entering the car seat market as well as the pet transportation market. So those are businesses that they weren't in. They're not very cyclical. If you go back and look at the history of those product categories over a long period of time, you'd be very pleased with the growth. And you can see from the slide, Thule since coming public has had a pretty incredible and consistent rate of growth of sales. So it's the type of business we love. It's very cash generative, earns north of 20% returns on capital, very high margins, no debt. And we're buying it at great prices today because, shockingly, the bike market is shrinking because post-COVID, turns out a lot of people took up activities that they weren't going to stick with. And the 50% growth that they saw in 2020 and 2021 wasn't sustainable. And so some of that is normalizing. But that was to be expected. And also, I think people forgot that they're a product development company. So we're really excited about these new product launches. And we think that they're going to create a growing segment for Thule within juvenile and pet. And we just don't think other people are paying attention to that right now. The other business would be Westaim, which is a very different profile of business than Thule. Westaim is investing heavily, so over 100% of its cash flow is being reinvested to grow the two assets that they own. They're a very operationally minded asset management firm. So they've existed here in Canada for about 14 years in their current capacity. The management changed 14 years ago, kind of pivoted the business strategy. And the existing team is focused on really being a private equity firm in the public market. So their first investment was a Canadian insurance company that they bought. They carved out of another public company. It was not well managed and needed some tender loving care, and they were able to restructure that business and sold it for about double what they paid. After 18 months, they sold it to Intact. and then they returned all the capital to shareholders. And the two assets that they own today, they've owned for many years, and one they've been building from scratch. It's a private credit manager based in New York that now has $4 billion under management. And the other asset actually recently went public. So we were on AusBiz talking to the Australian market about how we thought that IPO would be a catalyst for a lot of value creation at Westaim, because there's a difference between owning a private asset and having a minority stake of a public company on your balance sheet. So sure enough, Skyward went public 3 weeks ago, and people are starting to finally recognize within Westaim the value that exists. So very high returns on capital, very competent management team, insiders own over 20%, and that's actually our largest holding in the portfolio.
Yeah, they're great insights. Now, before we do finish up, Greg, you are somewhat unconstrained geographically. The question is, how do you decide where to go, and how important is on-site diligence to your process?
Yeah, great questions. I'll maybe take them in reverse order. So on-site diligence is really the lifeblood of what we do. In our opinion, we think our clients hire us to not just trust, but verify. That's actually one of the core philosophies here. So things like, if you see on the next slide, management said, we're not big fans of management said. We have to then take that statement and prove it for ourselves, whether it be through our own ability to look back in history and validate what they're saying, or be able to speak to competitors, customers, suppliers, to be able to confirm important information. And so the example I always give is, in theory, you could go on the internet and go on a local MLS and probably find a property, and without ever visiting that property, you could probably make an offer and purchase that property. And depending on the property, maybe it's a condo, maybe it's brand new, there's no real need to go visit that property. But the types of stuff we're looking at, there's a real need to go visit the property. You want to understand how old is the mechanical, what does the surrounding area look like? Is there a lot of traffic nearby? Is it backing onto a school? What are the neighbors like? How well maintained has the exterior or the interior been? So we just think that there's tons of value to get from being on site and kicking the tires and asking the right questions. And then the analogy extends further, because at the end of the day, when you take the keys of that house, it's your house, and what the previous owner did is of little consequence. But in an operating business, that's not the case. People determine the outcome of that business, especially smaller companies. So we always flip the question around and can't imagine trying to invest other people's money without visiting, the assets and interviewing the people on site. So that's sort of how we think about that. And so you're right. Last year we were in 33 cities, 11 different countries, on 3 different continents, and we were only available for 6 months. The firm really only launched in June. So travel is important. We spend probably half our time out of the office, not behind our screens, and in the field at trade shows and meeting the various stakeholders in the industries and the businesses we invest in. So right now, a lot of Germany. There's been some really interesting opportunities there. The Nordics was a very heavy focus for us last year. And the US is always, busy, because it's the largest region by far, the most number of we believe, wealth creating companies in the world. So we're always finding reasons to cross the border to the south. It's a very easy flight.
Okay, Greg, we'll have to leave it there. No doubt we'll see you back here in Australia very soon. Thanks so much for your insights.
Thanks for having me, and I hope everybody enjoys the Insight Summit.